If you're a busy professional, you probably don't have time to spend hours trawling through Rightmove or reading endless reports. But skipping due diligence could cost you tens of thousands of pounds. So here's how you can make smart, efficient checks that protect your investment without it taking up your whole life. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment business called Freighter Property Partners, but this channel is all about your education. Obviously, when you're building a property portfolio, due diligence is one of the major parts you need to be good at when looking at and reviewing multiple deals. It gives you the opportunity to maximize the success of your investments and mitigate any risks you might have. The difficulty when you're busy is you don't have time to spend hours doing your due diligence, but you also need to protect your investment and ultimately mitigate your risk. In my experience, busy professionals investing in property do one of two things. They either rely too much on the investment agent or estate agent that they're working with, or they don't have time to do their due diligence, so they do nothing for years and years. Because you're busy, you obviously don't need to do everything yourself. You can rely on third parties and partners to help you with your due diligence, but these are a few things that you can do that don't take up hours and hours to protect your investment. This is essentially a checklist that you can follow every time you see a new deal, so you can do your due diligence in quite a short space of time. It might take you an hour, maybe a little bit more when you're just starting out, but you can then get used to this, get comfortable how you do your due diligence, and be able to look at multiple deals and review them relatively quickly. The first thing on that checklist is the location fundamentals. Before you even start to look at the cash required or comparable evidence, you need to make sure it's in an area that you believe in. It doesn't have to be the best place right now, but it needs all of the ingredients that you can be confident that it's going to have long-term capital growth. These fundamentals include employment, institutional investment, so hundreds of millions, if not billions of pounds worth of investment going into an area and improving it over time. Strong transport links, both locally and nationwide. So what are the train services like? Are there direct trains into other big cities, into London and other locations like that? And also, is there a local tram network to make it easy for commuters around the local area? Next, what are the institutions like there? Are there big universities, and are people staying on in those cities or those locations after they finish their studies? This is a great indicator of what rental demand looks like in that local market. And the final thing with these location fundamentals is, what is the affordability in that local market? Can local people still afford to buy local homes? Because that is a great indicator of what appreciation is likely to be in that area. If the local market can't afford to buy the average home, like in places like London, then growth will be limited because demand will drop. The second thing on the checklist is financials and structure. Does it financially stack up? How much cash do you need to purchase this property? Not just the deposit, this includes stamp duty, legal costs, broker fees. Can you afford to do it? Do you make a small profit every single month? This might be £250 to £350 a month. It's not life-changing when you're looking at buy-to-lets, but it should always make a small profit in the short term. Will you be able to get a mortgage on it? It needs to be able to pass the stress test that the lender will do on the rental income on the property. If the rental income or the yield isn't good enough, it might fail these stress tests, which means you won't be able to buy it with a 25% deposit, and you might need more cash to purchase the property. And then compare the yield versus the long-term growth opportunity. If it's in an area with good location fundamentals, the chances are the prospects of growth are pretty strong, but you also need to make sure it yields well. So in the current market, a 6 to 7% yield on a buy-to-let is a good indication of a good deal if it's in one of those growth locations. Yes, you can get better yields in other locations, but the better yields are usually in locations where they've seen a lack of capital growth in recent years, and that's the reason for that yield. You don't necessarily want to get into those locations because they've had a lack of growth. They're likely to have a lack of growth moving forward, and then it will limit your ability to build your wealth through the appreciation of the assets and refinance them every few years to scale the portfolio. 3, the property itself or the developer credibility. If you're buying on a second-hand market, you need to look at the property itself and what state is that property in. Will it mean that you're going to have to go and do work on that property, or is it ready to go? Is it a good quality property, and will it give you little hassle moving forward? If it's a new property and you're buying direct from a developer, you need to look at their track record. Do they deliver good quality homes, and do they deliver on time to specification? A developer needs a strong financial track record as well as a good track record of delivering projects on time. You should be able to find their reputation quite easily with just a quick Google. Look at their previous projects, look at clients who have given them reviews, and have a quick read of those. Obviously, with online reviews, there was obviously going to be some people that have had really good experiences, as well as probably a few that haven't had some good experiences. But if there's tons and tons of people that are saying stay away from the company, the chances are the developer hasn't got the best track record. The fourth point on the checklist is comparable evidence. The quickest and easiest way you can do this is look at Rightmove sold prices in a quarter of a mile of where you're buying that property. This can take you 10 minutes to see genuine comparable evidence that's sold in the local market. You can also look at things like the land registry, although there's usually a 6-month delay on all of the data on the land registry, which means it could be a little bit out of date already. This is a really easy and fast way that you can make sure that you're buying a property at the right price and not overpaying for this property. If there's a lack of comparables within a quarter of a mile, you can obviously increase that to half a mile and a mile, but don't increase it too much because then you might be getting into different locations and those prices can differ quite a lot. And the final thing on this checklist you need to do when looking at this is look at what your exit strategy is, and does this property give you that opportunity? Who's going to rent the property and who will you potentially sell it to in the future if and when you choose to? For rentals, you can speak to a few local letting agents, work out what the local demographic is. It shouldn't take you more than 15 minutes. And for selling that property in the future, you can look at what current properties are on the market and what type of properties they're being sold, and get an idea of the type of person you might sell this property to if and when you choose to in 5, 10, 15 or even 25 years. Something we do at my business, Freighter Property Partners, is streamline this process as much as possible for our clients by putting together a whole due diligence pack. This gives our clients the opportunity to review and ask questions about our deal very quickly because we've already collated a lot of the information that they would need to go out and find themselves. So if you are looking for a third party to help you with building your portfolio, then I'll put a link to the website in the description so you can book a free chat with one of the team. So we've discussed a 5-step process that you can follow that shouldn't take up much of your time when looking at this once you get used to following this process and you've done it once or twice. Remember, you're not going to be an absolute expert at this the first time you try it, but once you've done it a few times, you'll become super comfortable with how it works and be able to review deals within 30 to 90 minutes. If you're really looking to streamline this process, there are a few tools and shortcuts that you can use to cut this time further, but remember, it's your money. You need to feel confident on the deal yourself. The first thing you can do to cut down this time even further is already have a team of professionals that you know that you can rely on that will help you with this due diligence process. For example, when you're looking at the financials of a deal, you might want to send the deal over to your mortgage broker to make sure that you can get lending at the 25% deposit. We've already discussed things like Rightmove sold prices and Rightmove data, as well as the land registry, but you can always use third-party tools like property data, and I'll put a link to their website in the description. And finally, you can use a third-party company that can help you with all of this process to cut that time down significantly, rather than you having to go out, find the deal, and once you found the deal, then go away and do all of your due diligence on top of that, because it can be quite time consuming just to find the deal itself, let alone then go away and do your due diligence on it. So remember, due diligence doesn't have to be overwhelming. Just because you're busy doesn't mean that you shouldn't find the time to go and do this. If you really want to hit your long-term goals, you're going to need to invest in property sooner rather than later, but make sure you've done the right due diligence before you commit. The more you use this checklist, the more comfortable you'll get with it and the more confident you'll be to be able to review a deal quickly as and when you need to. Like I said, this doesn't have to take 5, 6, 7 hours to do your due diligence. You just need to know what you need to look at and how quickly that might take you to be able to make an informed decision on your next property investment. But that is it for today's video. So thanks again for watching, and I'll see you in the next one.